Good morning, everyone, and thank you very much for joining us today. My name is Leigh Treacy. I'm a partner at BDO and head of our Financial Services Advisory practice. I'm joined today by my colleagues Shrenik Parekh, Rafferty, and Aneesh Subhra. The first thing I wanted to say is that from everyone at BDO, we hope that you enjoyed the summer break, although the pace at which September is running currently makes that all a distant memory, certainly for me. I hope you're looking forward today to what promises to be an interesting session. Before I run through the agenda, I wanted to touch on a few housekeeping points, if I may. Today's webinar will be recorded, and as usual, we will circulate the slides and a recording in a few days' time. Your lines will be automatically muted throughout the webinar, and we would ask that you submit your questions to the panel throughout the session using the Q&A function, and then the team and I will facilitate the session after the presentation. There are 4 areas we're going to cover today. Rima, please could you move to the next slide? Over the next 40 minutes or so, and each of the topics will be considered in the context of the senior manager's regime. Today we'll be covering demonstrating reasonable steps in a hybrid working model, and that's a topic that's always very of a high degree of interest, certainly on the part of non-executives in particular, and those holding SMF functions. The ESG and the financial risks from climate change, customer duty, and then finally operational resilience. So on that note, without further ado, I'll hand over to Shrenik, who's going to talk about demonstrating reasonable steps in a hybrid working model, as I mentioned. Over to you, Shrenik.
Thank you, Leigh, and good morning, everyone. Just by way of introduction, my name is Shrenik Parekh, and I'm a senior manager within BDO's Financial Services Advisory practice. And since joining BDO nearly 5 years ago, I've worked with many clients across the financial services sector, leading skilled person and regulatory advisory assignments within BDO's governance and risk discipline, which has a particular focus on corporate governance and board effectiveness, risk management, conduct, and culture. I also lead BDO's proposition on the senior managers and certification regime, having assisted a number of banks, insurers, and more recently solar regulated firms with its implementation. I've also had the pleasure to deliver several training sessions to board members and executives on the topics of SMCR, the code of conduct rules, and running an effective board. Next slide, please, Rima. Thank you. Every firm has faced a multitude of challenges in responding to COVID-19, and it's clear that effective governance and accountability for decision-making is central to and continues to be fundamentally important for all businesses during this time. And the financial services sector is no exception. The PRA and FCA have made it clear that they want to take a pragmatic approach to SMCR compliance, minimizing the administrative burden for firms and being flexible where possible. However, this should not be confused with a relaxation of the underlying principle of individual accountability and the need for organizations to maintain robust governance arrangements. Many firms have questioned the impact that COVID-19 has on accountability for decision-making, and how individuals can demonstrate and evidence that they're taking reasonable steps during this change in style of working. But it's important to be clear. Again, the regulator views on the principle has not changed. One could argue, on the contrary, that evidencing reasonable steps has and may continue to be even more challenging in an environment where face-to-face interaction will not be as prevalent as it has been previously for many organizations. So the onus really is on the firm to adapt to the different environment we live in now under the SMCR, and naturally senior managers are very much part of that. SMF holders have had to make a number of tough and key decisions over the past 18 months to ensure that the impact of COVID-19 minimizes disruption and fulfilling the day-to-day obligations, not just in the short term, but also in the long term, where flexibility around future working is our new future. Picking a few of these areas, one which has been more challenging in this environment for senior managers is maintaining oversight of employees and the systems they're using. Consequently, there's a heightened risk of market misconduct and cybersecurity breaches. So reasonable steps in this context may mean implementing changes to monitoring systems, communication from management to teams about managing conduct risks, and ensuring these are managed within the organization's risk appetite. Boards and SMF holders should also carefully consider the impact of COVID-19 on its end customers and products. Consideration should also be given to whether the current control environment is appropriate and within risk appetite. So for example, has there been an impact on the distribution channels to customers or investors, the mediums of communication with them, and the systems and infrastructure which support the firm in executing its strategy? Of course, the well-being of firms' employees is paramount. And from my perspective, this pandemic has demonstrated that businesses within the financial services sector can sustain despite the recent impact on IT systems and infrastructure. But what continues to be a crucial and arguably the most important factor in delivering strategy and meeting objectives is human capital, specifically the general well-being of staff, which can often be overlooked. SMF holders should ensure regular check-ins with all their employees via team leaders. In some cases, this may now take place through video conferencing instead of being face-to-face. However, these are still an important medium for providing oversight and also as a form of effective communicating. For example, as a senior manager, if you're delegated responsibilities to an individual in your team who is working remotely or doing a mix of office and home-based working, it's important to maintain dialogue and ensure the same degree of, if not improved, oversight. Next slide, please. So we've touched on some of the key challenges that have faced SMF holders, but I also wanted to highlight some additional challenges for firms that we believe will continue to be important and sensitively managed looking to the future. It's important that firms continue to maintain a focus on culture. SMF holders should keep in mind that many of employees have found themselves under significant pressure over the past 18 months, balancing their workload in an abnormal and unprecedented way for extended periods of time. The regular reminders of the firm's values and standards of professional behavior can be really key in motivating and energizing individuals. Example setting and tone from the top, from the board and senior management, will be more important than ever. It's also important that compliance monitoring and the second line compliance function remains robust and effective. A compliance monitoring review is being delivered on time, but importantly, to the same level of quality as pre-COVID. I think the board and SMF holders should be asking some really important questions here. What has been the impact of hybrid working on the compliance risk assessment, testing of key controls, and effectiveness of the second line function? Do the conduct risk metrics or broader risk management metrics, key risk indicators within the MI provided to board members or SMF holders, do these need to be revisited in light of hybrid working and or changes in risk appetite or strategy? So it's really important for senior managers to reflect on the implications to the firm in its new style of working and what protocols they need to put in place to support them in discharging the responsibilities effectively. Next slide, please. Our governance and risk advisory team have undertaken a number of board effectiveness reviews for clients during the pandemic. Quite often, with these, we utilize case studies to assess the effectiveness for decision-making and record keeping. And one of these case studies we've actively actually selected over the past 18 months is the firm's response to the pandemic. And there are several lessons learned which should be reflected on in an open and transparent manner. Number one, what challenges did SMFs experience in achieving effective oversight? We've talked through some of these, but what actually are the high priority ones which need to be addressed should the same episodes reoccur in the future? Hopefully this is not the case, but the majority of firms I've spoken to have learned something in this regard. From an MI standpoint, were there flows that were disrupted? With the guidance from the government, which was changing on a daily basis and a significant amount of uncertainty, the board and executive team received the right level of information, or were there some lessons learned on how information and communications could have been distributed more effectively? What about the impact on BAU? How can the firm be more prepared and manage BAU more effectively in the future? We've seen a rapid shift year on year in the way that firms are reporting on conduct risk exposure and breaches. Naturally, there's more of a focus on this from the regulator in respect of the impact of customers or investors. So with the regulatory focus in the area, we expect regulatory scrutiny surrounding governance and conduct will only just get stricter over time. To say it's a period of change is certainly not an understatement, but in order to maintain relations with key stakeholders such as customers, investors, distributors, suppliers, employees, we have observed that many teams have established a cross-functional hybrid working group led by a member of the executive management team who will keep these issues front of mind and bubbling at the surface. ensuring there's a mechanism in place to deal with a variety of potential impacts on the business in real time and in a measured and considered way. There should be a consistent understanding and expectations for behavior, output, and conduct, both in the office and remotely. Next slide, please. I also wanted to cover what we are seeing and hearing in terms of the practicalities of operating effective corporate governance. In times like these, the need for clear and decisive leadership based on reliable information is more crucial than ever. The buck stops with the board. We all know that an effective board defines the company's purpose and then sets a strategy to deliver it. While management teams run companies on a day-to-day basis, boards are ultimately responsible, even in times of uncertainty. So the starting point for boards is this new approach to working. It's to direct the company in a way that is effective for all key stakeholders. Transparency and effective communication has become even more important during the crisis. We've touched on this briefly previously. And just to draw an relevant example here, I've been working with a solar regulated firm who'd been planning hard to meet the 9th December deadline to be SMCR compliant, had a dedicated project team in place to support the firm with its implementation of SMCR. But once the deadline passed and when it actually came to BAU, the project fell away, as well as the support and oversight from key stakeholders, including business functions, for example, HR, compliance, and COSEC. So for this particular firm, which was going through quite a high turnover of senior managers, there was a number of administrative errors, which led to SMF application deadlines, sloppy handovers, and when we analyzed the incidents, it was actually clear that the root cause was poor and ineffective communication across the firm. Board members and SMF holders need to ensure they have access to the relevant information. And this is not just true for office working, but also remotely. Are packs being circulated on time, and is the MI clear, accurate, and pitched at the right level? With the introduction of SMCR, there's a risk of information overload and inflation of management information packs, as senior management want to ensure that they're demonstrated they've acted reasonably by escalating everything. So it's the responsibility of the committee chair and the non-executive directors receiving the MI to challenge its appropriateness, both in terms of quality and quantity. The quality of the relationship between the board and executive management is more critical than ever, and it's imperative that there is no confusion on who does what. And just as an example here, when I speak to many of the NED community, they say attending the board meetings is only one responsibility of their role. But it's their communication with the exec team in between meetings that they discuss key issues and pick up the organizational culture. In a world with flexible working, they're likely not going to be able to walk the floors of the firm as much as they used to. And therefore, the interaction and dynamic between the board and executive team is even more important and crucial, not just at governance meetings, but also in between the meetings. Given the shock that this crisis has presented to financial markets and its potential long-term implications, it has never been more important to maintain clear and complete audit trails for all key decisions that are made. Ultimately, the firm's records need to be kept in a way that is readily available and presentable to the regulators on demand. And many boards and management teams will be meeting via video conference. There's a challenge that meeting minutes may not necessarily reflect robust challenge that each input individual has made into collective decision-making. And therefore, it's really crucial that each SMF holder takes personal accountability for responsibilities they're discharging. Given the fast-moving nature of the world we live in today, regular virtual meetings with senior management could be scheduled to identify new developments, understand regulatory expectations, and the impact of policy decisions on the firm's business. Records should be kept of key decisions taken at meetings to demonstrate how the management team has responded and what key issues have been considered. We also suggest maintaining a personal record of CPD and training or webinars such as this one that you have attended today. Next slide, please. So just to conclude my session, it's time for our first interactive poll, which I hope will run smoothly and that you will enjoy. You should hopefully see the poll question on your screen in a couple of minutes. So please submit your answer and we'll share the results in a few seconds once the majority have participated or voted. the question is, which one of the following do you feel is most important in ensuring continued effective oversight by SMFs in a hybrid working model? Good quality and transparent management information, engagement with management below board level, a robust second and third line of defense, clarity and consensus over the firm's purpose, values and risk appetite, or a flexible and an open approach. So please select the option which you think is most important. Wait, there's quite a few people on the webinar, so we'll just give it a few seconds before we go to the results. That's really interesting, and looks like we have a number of a favorite in number one, the quality and transparent MI, and naturally you could argue that all of these answers are valid, but I agree. If I had to pick one, good quality and transparent management information is really important, and I think will be and continue to be very relevant in a hybrid working model. So that, it's really important to get the appropriate, timely, and pitched at the right level MI. And I think following that, again, engagement with management below board level, again, incredibly important, more challenging with a hybrid working model. But yeah, I completely agree with that result. So thank you for sharing. And on that note, I'll now hand over to Claire, who will present on ESG, climate risk, and the topic of customer duty. Over to you, Claire.
Thanks, Shrenik. Hi all, my name is Claire Rafferty. I'm a senior manager in the regulatory conduct team here at BDO. I focus on wholesale and market conduct issues. I'm just going to touch on two kind of key evolving regulatory topics, ESG and then the FCA's proposed new consumer duty, and consider their SMCR implications. Next slide, please, Rima. So climate change and ESG is obviously a big regulatory and market topic at the moment. Climate change has the potential to impact firms' business models, cash flows, financial position and performance. So regulators have begun to exercise their powers in obligating firms to put considerations of climate risk at the heart of their business strategy. They're also focusing on improving the quality and consistency of disclosures around sustainability, which will hopefully enable investors and market participants to make more informed choices and influence positive change in that way. As I'm sure you'll be aware, PRA regulated firms are a little bit further down the path. Back in 2019, the PRA issued Supervisory Statement 319, which requires that firms take a strategic approach to identifying, managing and disclosing climate-related financial risks, and consider how actions today will affect future financial risk. This approach should be proportionate to the business and mature over time. The PRA's expectations around this strategic approach are categorized into four key areas: governance, risk management, scenario analysis, and disclosure. The PRA's expectations for 2021 are to have fully embedded the approach to managing climate-related risks by the end of 2021. That is not to say that your climate risk management framework is going to be perfect, just that you have begun to think about embedding those considerations within your strategy. So there should be a clear high-level strategy that addresses the climate-related financial risks associated with your firm's clients and counterparties. There should be clear and effective governance over climate risk. Your firm should have credible plans and policies for addressing climate-related risks that is embedded within the existing risk management framework of the firm. Firms are expected to have begun exploring and considering relevant scenarios and stress testing those scenarios. And finally, undertaking some disclosures in line with the TCFD. So at the end of June 2020, the joint PRA and FCA Climate Financial Risk Forum released detailed guidance to help firms understand and respond to the risks and opportunities that arise from climate change. From the 1st of January this year, the FCA introduced rules requiring premium listed companies to make better disclosures about how climate change affects their business. In June this year, the FCA published a consultation proposing climate-related disclosure requirements for asset managers, life insurers, and FCA-regulated pension providers. Larger in-scope firms will be required to produce their first entity-level disclosures by the end of June 2023, and smaller in-scope firms by the end of June 2024. The FCA's expectations for this year are really around demonstrating that implementation work has begun. So that will include establishing clear and effective governance over climate risk and beginning to embed climate risk consideration within your strategy. I will note that the FCA are expected to release an ESG handbook shortly. Current PRA and FCA expectations are not strictly binding requirements at this time, though they do expect in-scope firms to take action now. And more broadly, you'll be aware that there are European initiatives also underway around climate risk disclosures, and there's also a EU taxonomy. So the UK government have said that they plan to at least match the ambition of those programs, and hopefully they will be largely consistent in the future, Brexit notwithstanding. Next slide, please, Rima. So as per Supervisory Statement 319, the financial risks from climate change arise through two primary channels or risk factors, physical and transition. Physical risks from climate change arise from a number of physical factors and relate to specific weather events and longer term shifts in the climate. Transition risks are probably more relevant and difficult to quantify because they arise from the process of adjustment towards a low carbon economy. So the impact of climate related developments in policy and regulation, the emergence of potentially disruptive technology or business models, shifting sentiment and societal preferences, and evolving evidence frameworks, legal interpretations. Obviously, the financial risks from climate change have a number of distinctive elements. They're far-reaching in breadth and magnitude. It's an uncertain and extended time horizon. There's a dependency on short-term actions, and an argument could be made that they are foreseeable to an extent in nature. Next slide, please, Rima. So it is challenging for SMFs. The PRA expects that firms designate clear accountability for climate within the board and subcommittees, ensuring that any individuals or committees designated with this accountability are sufficiently qualified and trained in climate risk, and ensure that boards are supplied with a sufficient amount of high quality, relevant information from senior management. So these steps should enable boards to effectively debate and take decisions in a way that is comprehensively informed by climate risk. It's interesting to note that back in 2015, the PRA carried out a detailed analysis of the specific impact of climate change in the UK insurance sector, specifically on directors and officers' liabilities. So it includes a section devoted to liability risks for directors and officers, and it contains some interesting comments, which I'll quote. Potential causes of action against directors and officers may include, for example, shareholder derivative actions for breach of statutory or fiduciary duties, or seeking compensation for a loss of corporate value attributable to a failure to mitigate or adapt. Claims may also be based on a failure to disclose or misleading disclosure in relation to the risks associated with climate change, particularly as the requirements for related disclosure and reporting become more stringent. It would seem increasingly difficult to argue that impacts on corporate value arising from a failure to manage risks associated with climate change are not reasonably foreseeable on the basis of prevailing scientific and economic evidence. Failure to adapt claims could be distinguishable from those arising from the corporate collapses relating to the global financial crisis, which were often viewed as sudden and broadly unforeseen, Rather, such claims may be more closely analogous to other cases of alleged failure to manage structural or systemic transition risks. So I think this makes salutary reading not only for the D&O issuers and whom it was originally aimed, but for board members in general, and particularly for those who are contemplating the assumption of additional responsibilities in light of Supervisory Statement 319. So it's not only going to be pressure from regulators and within the confines of SMCR, there's also going to be broader obligations to shareholders and the market that you're operating in. So while it's relatively early days for embedding climate risk as part of your firm's strategic approach, we have seen some examples of best practice at the moment. So we're seeing that climate risk is being considered as part of firms' strategy, risk appetite, and risk management framework. We're seeing initial risk assessments and risk impact analysis relation to climate change being undertaken. And those are proportionate to the extent of climate risk a firm is exposed to. If you do a very narrow, specific, geographically confined type of services, then your potential risk will be limited in scope, and so that's fine for your risk assessment to reflect that. Firms are beginning to undertake an initial gap analysis against PRA expectations. We're seeing formalized project plans, project support and assurance in relation to climate change, including defining governance structures. So as Shrenik suggested with the hybrid working model, it can be very useful to have a dedicated working group established with a specific SMF accountable executive leading the project to implement it. We're not suggesting that one individual should take on responsibility for climate risk, but more the project of embedding considerations of climate risk on a temporary basis. Targets relating to climate change have been identified and will be monitored by the firm internally and publicly. And responses to regulatory expectations, acknowledging that this is an evolving topic, and frameworks will be iterative, subject to frequent change. On the next page, Rima, on the next slide, we have a quick poll, 2 quick polls, just to in the interest of audience engagement. Do you think there should be a prescribed responsibility for climate risk within the SMCR? Yes or no? This might be one where non-SMFs vote yes and SMFs vote no, but we'll see what the results are. So yes, surprisingly, there should be a prescribed responsibility for climate risk within the SMCR. Okay, that's interesting. And on that topic, who do you think should take responsibility for that prescribed responsibility? Should it be the CEO, the CRO? Well, should it form part of every SMF SOR, or should there be, I don't know, maybe the COO or kind of part of operational risk side of things rather than general risk? Should form part of every SMF SOR. Yeah, I think that's probably the right answer, that it should form part of every SMF SOR. And I think that will go some way to answering, we have a question from the floor. Is there any idea of what will be the SMF's impact on third country branches, given that the governance in this topic usually sits with head office? So I think that the SMFs responsible for overseeing the activities of the UK branch will need to include some kind of consideration for this. But we can return to that at the end of the topic, at the end of the session, with some other questions, if that's okay. I'll quickly move on to the next topic, which is around the FCA's proposed consumer duty. Rima, can we go to the next slide, please? So this was proposed by a consultation paper back in May. This idea has had a long incubation period with the FCA. They first published a discussion paper on the issue of firms' duty of care with respect to consumers back in 2018. It's part of discussion paper 1805. This CP outlines plans to create a higher level of consumer protection in retail financial services through a new overarching consumer principle and a set of cross-cutting rules and outcomes to support that principle. So the proposed rules would require 3 key behaviours from firms, and then include specific measures in relation to 4 key elements of the firm-consumer relationship: communications, products and services, customer service, and price and value. So while the FCA has described the proposals as a paradigm shift in its expectations of firms in retail markets, the FCA stresses that the new consumer duty would not remove consumers' responsibility for decision-making or in itself prevent consumers from making decisions that are not in their interests. It won't require consumers of a product or service to obtain the same terms or outcomes. It won't impose an open-ended duty that goes beyond the scope of the firm's role and its ability to determine or influence consumer outcomes. It won't remove or supersede the need for specific rules or guidance, which may be necessary to mitigate specific consumer harms, because this does represent a move away from quite specific rules. It will not specify exactly how firms should act, and it will not apply retrospectively to past business. The rules and guidance which will introduce the new consumer duty will be in place by July 2022. So given that the FCA intends to publish those final rules in Q1 2022, firms won't have the luxury of a huge amount of time to map the potential impacts of the new consumer duty and to organise for its implementation. So I think it's definitely something that's worth thinking about now. I think that the way to approach it is along 3 key pillars that should already be operating within your business. So the first is SMCR, thinking about customer outcomes through the lens of individual accountability, revisiting the SOARs and considering to what extent there is responsibility taken for the ultimate outcome for consumers. The second pillar is, I think, product governance. So does your existing process focus sufficiently on customers' best interests and outcomes, going beyond a narrow focus on compliance with the rules? So over the last kind of 5 years since MiFID came into force, the FCA has done a lot of work to encourage firms to produce robust product governance frameworks. So I think that that is a really good starting point in considering, how to implement this element of the regs. And finally, the third pillar is going to be around data. And a good place to start is considering what data you currently gather, largely as part of the annual product governance process. So there's a new emphasis across each of the 4 outcomes on monitoring and testing. So the FCA will likely require firms to provide evidence of the information and data used to inform this testing. Furthermore, firms will be expected to identify if particular groups of customers receive systematically poor outcomes and to take action if this is found. So this is around not only considering the data that you're taking in, but considering cutting it in different ways, analysing it in different ways. So I think gathering customer feedback and undertaking customer and market research will be key, and most firms will need to develop the appropriate mechanisms to do this. So we have a quick poll on the next slide before I hand over to my colleague Aneesh. So the FCA has referred to this as a paradigm shift. Do you think this represents a sea change in the FCA's approach, or do you think it's kind of a gentle evolution or more of the same from the FCA and won't actually have a particularly significant impact once it's in force? So obviously the FCA is somewhat undergoing a lot of changes internally. They're had a couple of very high profile failures recently, and as a result they're undertaking a transformation project to revise their approach to supervision and regulation more generally. I think this definitely fits into that, and yes, there is skepticism about how much of a change this approach actually warrants. I mean, as many of you are aware, enforcement action can only be taken on the basis of very strict rules. It's very difficult to take action on the basis of principles, or you're on quite uncertain ground, I think, when you move away from stricter rules. But we'll see what happens in the next year, and we'll see what the next consultation on this topic looks like. Thank you for participating in the polls. I'll hand over to my colleague Aneesh, who's going to speak on operational resilience. Thanks, Aneesh.
Thanks, Claire. And good morning, everyone. My name's Aneesh Subhra, and I am a senior manager in BDO's FS advisory practice, where I specialise in governance and risk management. Most recently, I've been focusing on supporting firms across the FS sector on the implementation of operational resilience requirements. Next slide, please, Rima. So I'm sure everyone is well aware, operational resilience is very much a hot topic and focus area for both the FCA and PRA. And this part of the presentation will provide a high-level overview of the new requirements, the timelines for implementation, and expectations with regards to operational resilience governance, including the role of the board and SMCR. So by way of background, the policy statements and accompanying supervisory statements published in March this year represent the culmination of almost 3 years of policymaking by UK regulators, and really reconfirms their supervisory approach for promoting resilience within the FS market, and also the expectations that firms are required to meet in delivering operational resilience. The publications shown on screen therefore give firms the basis on which they can now proceed with plans to assess and improve their operational resilience. Next slide, please, Rima. So before going into the specific requirements set out in the policy statements, I wanted to highlight the associated timelines with regards to implementation. You will note from the slide that there is a relatively short implementation period despite significant pushback from the FS industry, and the regulators have maintained their proposed timeline and given firms a 12-month implementation period for initial work. What this means is by March next year, firms must have identified their important business services, carried out mapping, defined impact tolerances, and carried out scenario testing. As part of this, firms must also have identified any vulnerabilities in their operational resilience and have clear plans in place to address this. Following the 1-year implementation period, a 3-year transition period begins. This means as soon as possible after 31st of March next year, and no later than March 2025, firms must be able to demonstrate to the regulators through scenario testing that they are able to remain within their impact tolerances for each important business service. Linked to this, firms must also have made the necessary investments to enable them to operate consistently within their impact tolerances. Next slide, please. So in the main, the operational resilience framework set out in March this year do not significantly differ from what was outlined in the December 2019 consultation papers. More specifically, a number of key aspects remain in place, which are listed on screen. For example, firms are still expected to focus on and identify their important business services. Although it's worth noting that the definitions of what constitutes an important business service differs between the FCA and PRA. As such, dual regulated firms need to ensure that the criteria or methodology used to define an important business service appropriately takes into account both regulators' definitions. Following this, firms are required to map all the supporting resources, which includes people, systems, processes, and third parties, which support the delivery of each key business service. The regulators are expecting that the mapping exercise by the end of March next year has been undertaken at a granular enough level in order to support in the identification of any vulnerabilities in resilience. The regulators then expect firms to set impact tolerances for each key business service. Broadly, both regulators were expecting that impact tolerances define the maximum tolerable level of disruption, reflecting the point at which any further disruption to the important business service could cause intolerable harm to the firm's clients or pose a risk to the soundness and financial stability of the firm or the broader UK financial system. It's however worth noting that again, there are slight differences in the definitions prescribed by the FCA and PRA regards to what firms should consider when defining their impact tolerances. So dual regulated firms need to ensure that the tolerance is defined appropriately, taking into account both regulators' definitions and criteria. The next key requirement is around scenario testing, and this is a really important component of the requirements, as the whole operational resilience framework is built on the fact that firms need to demonstrate to their supervisors that their resilience falls within the impact tolerances they have defined. As a result, firms are expected to assess their resilience of key business services against severe but plausible scenarios. The regulators haven't been prescriptive about what kind of tests firms should be conducting or scenarios to be used, but are keen for the sector as a whole to develop innovative ways of simulating disruptions in order to demonstrate resilience. Firms are also required to document their internal and external communication strategies so that they can respond quickly and effectively to disruption in order to help reduce harm caused by operational disruptions. For their internal communication strategies, firms should include the escalation paths that will be used to manage communications during an incident and identify the appropriate decision makers along the way. As part of their external communication strategy, firms should consider how they would provide important warnings or advice to consumers and other stakeholders, including where there is no direct line of communication. Finally, firms are required to formalise an operational resilience self-assessment document, which essentially records the firm's overall operational resilience journey. As a minimum, the document should include all of the areas discussed, as well as the methodology used to undertake these activities. I think it's probably fair to say that at some point, the regulators will request this document in order to determine whether firms have appropriately complied with the expectations. So it's vital that firms take this document seriously and treat it as a living document and periodically update this document when they deem necessary. Whilst all the areas I've discussed are broadly the same concepts echoed in the 2019 consultation papers, the regulators have helpfully made a number of smaller changes, clarifications, and observations. So the first clarification is around proportionality. The regulators stress that their approach to the proportional application of the framework is to be non-prescriptive in most areas to allow for firms to design an approach that suits their circumstances. For example, both regulators have declined to create a template for the self-assessment, stressing that really it's for firms to decide what they think is most appropriate based on the size of their business and nature of business services. With regards to impact tolerances, the regulators have clarified that while impact tolerances should have a time-based metric for resumption of services, they can also be expressed as a combination of time and non-time-based metrics, such as the volume disrupted. The regulators also clarify that dual regulated firms may at times need to set 2 impact tolerances for each important business service, given the different objectives, as I mentioned earlier, but have both stressed that it's acceptable for firms to focus on the most stringent impact tolerance, provided that they can demonstrate to the regulators that they have taken into account both of the regulator's key objectives. And finally, with regards to the frequency of testing, the regulators have clarified that the requirement to test regularly does not mean that testing must be carried out for all business and services on an annual basis. They do, however, stress that testing should occur more frequently, where, for example, operations of a firm change in such a way that materially alters the mapping that is carried out for each business service. Next slide, please. So given the focus of the webinar today, what does this all mean in the context of SMCR and broader governance? I think it's firstly worth highlighting that the regulators haven't been too prescriptive on what they expect in terms of operational resilience governance. However, they do prescribe a number of high-level overarching statements around the role of the board, senior management, and management information. In the context of SMCR, fundamentally, the regulators expect that there should be a clear allocation of responsibility and accountability with regards to operational resilience. Firstly, firms need to have clarity on the senior manager who has overall responsibility for delivering operational resilience. While we acknowledge that elements of a operational resilience outcomes are likely to be spread across management, service owners, and process owners, it's still vital that there is a central point of responsibility for the implementation of the framework as a whole. When considering overall responsibility, firms need to have a clear delegation of responsibilities where an important business service is supported by a range of people, systems, processes, and third parties. Therefore, it is our view that as part of their broader implementation of resilience requirements, management should be assessing their current suite of senior managers in order to identify which individuals' scope of responsibilities most closely align with those linked to operational resilience and determine how this individual can demonstrate and evidence reasonable steps. The natural individual, as suggested by the regulators, is the SMF24, the Chief Operations Function, given this individual is typically responsible for areas such as business continuity, internal operations, and outsourcing. Where the SMF24 is split, which is often the case, firms need to think carefully which of the individuals should have overall responsibility for operational resilience. On a practical basis, regional steps should demonstrate that the SMF24 has appropriate oversight of the operational resilience framework as a whole, and also oversight of the relevant individuals who are responsible for supporting delivery of each important business service or the wider components of operational resilience. The SMF24 or relevant senior manager should also play a key role in identifying the target resilience ambition of the firm and ensure that there is a clear plan in place to achieve this. This senior manager should be responsible for owning the plan and periodically updating management and board committees on the progress made. Firms, where applicable, should also consider individuals who have been assigned SMF6, i.e. the heads of key business units, and ensure that these individuals are responsible for embedding operational resilience into their business areas on a day-to-day basis. Once this has all been considered on a practical basis, firms should ensure all relevant senior management statements of responsibilities, job descriptions, and reporting lines are updated to reflect new responsibilities and oversight arrangements with regards to operational resilience. Another one of these overarching statements and expectations with regards to governance relates to the board, in that the regulators expect firms to ensure that their boards are engaged in defining effective standards for operational resilience across the firm. The way in which we interpret this is that boards should set and agree clear standards and objectives that they expect management to meet in respect of operational resilience and periodically assess whether these objectives are being met. The standards and objectives should be developed in tandem with management and should be documented within a formal operational resilience strategy or policy, which is ultimately owned by the board. The strategy or policy should clearly outline the current operational resilience capabilities of the firm and future plans with regards to improving operational resilience linked to the 3-year transition period timelines prescribed by the regulators. In addition, the regulators also expect for the self-assessment document to be reviewed and approved by the board to further evidence the board's engagement in setting operational resilience standards within a firm. Finally, the board should be responsible for approving the operational resilience framework as a whole, which I will touch on shortly. In order for the board to provide effective ownership of the framework and to appropriately challenge management and operational resilience capabilities. The regulators emphasise that boards should have the appropriate collective knowledge, experience and skills with regards to operational resilience and the requirements themselves. As such, as part of their implementation of requirements, firms should be considering whether the board as a collective has the appropriate skills and knowledge on operational resilience. Where it's identified that enhancement or improvement is needed, management should be proactively providing the board with the appropriate training and awareness sessions to facilitate their knowledge and skills. It's likely that regulators will at some point probe this and the steps firms have taken to ensure board expertise is at a sufficient enough level to challenge management. And we have seen this in the past, particularly with regards to areas like cyber and information security, where regulators have ultimately concluded that in a number of firms, board expertise has not been at a sufficient enough level to provide effective challenge to management on these areas. More broadly, firms should be assessing the existing governance structure and arrangements and consider how these can be adapted and utilised to ensure there is effective oversight of operational resilience. Specifically, we would expect there to be clear reporting arrangements that allow for information to flow throughout the governance structure to ensure that progress against operational resilience objectives can be monitored and appropriately challenged by senior management and the board. And this point is explicitly brought out in the policy statements in that the regulators expect the board and senior management to have appropriate MI made available to them to inform decision making, which has consequences for operational resilience. In terms of the MI, we'd expect that it highlights key resilience issues and trends and be measured against the targets which have been set by the board, as I mentioned previously. Given the nature of operational resilience and all the building blocks which in turn support resilience, this MI will likely need to be drawn from a range of sources so that number one, that it can give an indication in regards to the likelihood of disruption occurring, and two, also the potential impact of it should the disruption occur. On a practical basis, the operational resilience MI should be embedded into the existing reporting structures and provide an overview of any disruptive events that have occurred, highlighting any vulnerabilities identified or lessons learned, and incorporate the results from scenario testing undertaken. The information reported to the board and senior managers, in our view, is a really important component of operational resilience governance. And I think it's likely at some point the regulators will request the MI in order to make their assessment of whether the board and senior management are receiving the appropriate information to allow them to understand the risk and resilience profile of the firm. Overall, I think if a firm considers and implements the points that I've discussed, it goes a fair way in demonstrating to the regulators that firms have robust governance arrangements with regards to operational resilience, and that senior managers are importantly taking and can demonstrate reasonable steps. Next slide, please. So the final element I wanted to touch on was around firms designing a operational resilience framework. I think this is a really important element given the number of new regulatory rules and guidelines proposed by the regulators. And without a documented framework for operational resilience, in our view, there's a risk that firms may fail to identify and understand resilience-related challenges and effectively plan for disruption. Importantly, the framework will also allow firms to demonstrate to the regulators that they have taken operational resilience seriously and considered how resilient links with wider governance, risk management and business continuity arrangements across the firm. To that end, we have identified a number of components of what we see as an effective operational resilience framework. And it's worth saying, ultimately, the board should be responsible for approving this framework and senior management responsible for implementing it. So starting at the top of the pyramid shown on screen, with regards to risk appetite, we consider it appropriate for the firms to articulate and recognise business disruption as one of its key risk categories. To support this, the risk appetite could be enhanced to include metrics or KRIs in relation to resilience-related risks that measure the likelihood of disruptive events occurring. Next, firms should consider formalising an operational resilience policy, given a number of new regulatory rules and guidelines. And it's our expectation that the policy should be owned by the SMF24 or relevant senior manager and be subject to regular review and be communicated and understood throughout the firm. In our view, the policy should firstly highlight a clear definition of operational resilience and what this really means to the firm. In addition, the policy should outline the key targets and strategic objectives of the firm with regards to operational resilience. The policy should also outline the firm's governance and oversight arrangements with regards to operational resilience, and as a minimum considered the areas that I discussed earlier, for example, the role of the board, the role of the senior management, SMCR, and also the operational resilience MI requirements. Linked to this, we would expect the policy to highlight the roles and responsibilities across the 3 lines of defence with regards to operational resilience. The policy should also list the specific regulatory rules and guidelines that are relevant to the firm, and also the methodologies that have been developed to support compliance with these rules. In addition, and firms should definitely not lose sight of this within the wider requirements, the policy should outline the firm's internal and external communication strategies in the event of a disruption. The policy should also outline what should be included within the self-assessment document, and importantly, evidence who is responsible for completing this and how they will go about maintaining it. As mentioned earlier, this document should be treated as a living document and be updated on a periodic basis. So it's vital that the policy should include key requirements and expectations around this. Finally, and very importantly, the policy should also identify the wider building blocks that support the firm's operational resilience capabilities, describing how these building blocks work together to help reduce the likelihood of disruption occurring and also minimising the impact should that disruption occur. A few examples of key building blocks which are listed on a slide include cybersecurity management, third-party risk management, business and IT continuity, and also change management. I think this is a really important component of the operational resilience requirements, and what's come out from the regulators shouldn't be viewed in isolation. And for firms really to deliver operational resilience, it's fundamental that these building blocks are robust, effective, and work in tandem. And I don't think it's a coincidence that alongside the policy statements published in March, the PRA published a policy statement and accompanying supervisory statement on their expectations with regards to third-party risk management and how firms need to take steps to ensure that the resilience arrangements within these third parties is appropriate. As a concluding statement, it's our view that if firms design and implement an operational resilience framework and ensure that there is effective governance over that framework, and there are clear linkages to wider frameworks, it will go some way in demonstrating to the regulators that the firm is delivering operational resilience. I'll pause there and hand back over to Leigh for concluding comments and for Q&A. Thank you.
Thank you very much, Aneesh, and to the speakers. We've got a couple of really good questions that have come up on the Q&A. I'm conscious that we are approaching the end of the session, but if everyone, those that are able to stay on for a few extra minutes, we will run through the questions that have been logged. Shrenik, I think the first one is for you, from Alessandro Paluccia from Natixis, I think. Is there any idea of what will be the SMF impact on third country branches, given the governance on this topic usually sits with the head office?
Yeah, thanks, Leigh, and thank you for the question. I guess from my perspective, depending on where, whether the third country branch is dual regulated or solo regulated, the firm will still need to allocate the relevant SMFs, and third country branches must allocate a list of tailored prescribed responsibilities among the SMFs in the PRA rulebook and FCA handbook. So yes, I would argue that whilst aspects of governance, of course, sits with the head office, SMCR is applied at the entity level for firms regulated by the FCA and PRA, and the underlying principle of accountability for decision-making for senior managers and the requirement to demonstrate reasonable steps at third country branches does not change. So from my perspective, the change in approach to working has heightened the importance of the relationship and interaction between the head office and the branch, and as well as the need for timely and effective communication, not just at the governance meetings, but also in between those meetings.
Thank you, Shrenik. Sasha just mentioned my building work noise in the background, so I had to go on mute. Apologies to everyone. Second question is one for Aneesh. Yes, for Aneesh. How should the SMF4 be involved in operational resolution for a small mutual?
So I think the role of the SMF4 is key in delivering operational resilience, and it goes back to providing effective challenge to the first line business functions and to the SMF24 in terms of how well they are implementing these requirements. Also from a governance perspective and MI perspective, information that in regards to the MI that's reported to the relevant management committees that gives assurance on the overall resilience of the firm should be challenged by the SMF4. And I think they have a key role in sort of providing that challenge on an ongoing basis based on information that is reported to them.
Thanks, Aneesh. And then a final one also for you, I think, is how to overcome the potential risk of overlapping frameworks, especially with regard to risk management statements, risk appetite statements, versus the BCP, LCP, recovery planning, etc., which already exist. Is it sufficient just to link these existing items?
Yeah, I think it's a good question. And while operational resilience is a relatively new concept, the fundamental components which deliver operational resilience within an organisation have existed for a long time. So, for example, with the risk appetite statement, I think it's key that firms make the distinction between risk appetite, the supporting KRIs and metrics, and how that differs to impact tolerances. So, for example, the risk appetite and supporting metrics should help identify the likelihood of disruptive events occurring, whereas the impact tolerances assumes the disruptive event has happened and how quickly firms will be able to bring that disruption to a close and resume their business services. And then also wider arrangements around business continuity and recovery planning. I think firms just need to make it clear within their policy, where operational resilience ends and business continuity stops. That operational resilience focuses really on the business service as a whole, whereas business continuity tends to focus more on systems. And I think as long as these arrangements are documented, if ever challenged by the regulators, the firms have that answer in terms of how they've satisfied the regulations, or these new regulations, and how they link with the wider frameworks around business continuity, disaster recovery, third-party risk management, cyber, for example. And I think it is sufficient to state within the policy how this works, how cross-reference to other policies that would exist for an organisation to evidence that link between operational resilience and areas such as business continuity, for example.
Thanks, Aneesh, for that comprehensive answer. And on that note, I'd like to say thank you to all of you for joining the session today, and to the panelists. Thank you, and hope you enjoy your day further. Bye-bye.